Okay, we're back. Now, I ended last time at the topic of conservatism, and conservatism was long considered a cornerstone of proper accounting, that proper accounting should be conservative. Now, what did conservative mean? Well, generally, you see right here, meant that we were quick to recognize bad news and slow to recognize good news. As they say right here, conservatism means that accountants require greater verification before recognizing good news than bad news. Now, you don't have to think any further than contingencies to think about a good example of conservatism that we still see in accounting. Where there is a contingent liability, we have to look at it and consider either disclosing it or both reporting it and disclosing it. Okay, so right here they say the result is that losses are reflected in net income more quickly than gains, and net assets tend to be biased downwards. Yeah, that's conservatism. So with loss contingencies, we have to consider recognizing a liability and a loss. If not, then we have to consider at least disclosing it. Now, with a gain contingency, the most we can do is just disclose it. And you only disclose it if it's pretty certain. So that's an example of conservatism. We see it a lot in accounting. The concept of lower of cost or net realizable value with inventory is an application of the conservatism concept. So we see it in a lot of places. Now, to understand conservatism, you really have to kind of go all the way back to the basic concept of faithful representation, or what we called in my day representational faithfulness. Now, faithful representation means that information is complete, it is neutral, and it's free from error. Now, remember, neutral meant free from bias. So right here they talk about that. And so in concept statement 8, when it came out, basically it said that conservatism could no longer play a part in accounting standard setting. And the reason was that it introduced a systematic bias. And the truth is, they're right, it does. But it's not a bad bias. It's a bias that says, if we're unsure, we're going to make ourselves look worse rather than better. And, you know, I've never heard of an investor suing because you reported something bad and it didn't come to pass. That you predicted that, or didn't predict, but you reported that there was a possibility of something bad happening and it never came to pass. Now, if you missed reporting that there was something bad out there that investors should consider, you get sued over that. And that's what led to the conservatism concept, the idea that we need to warn investors about things we can see on the horizon that may cause problems. So, SFAC, Statement of Financial Accounting Concepts, number 8, rejected conservatism, but we still see its fingerprints all over accounting standards. And you see down here at the bottom of this paragraph, despite the lack of support for conservatism in the conceptual framework, it's likely to persist as an important consideration in accounting practice and in the application of some accounting standards. So even though it's theoretically out of accounting, in reality, it's really not. Now they move on, get into these enhancing characteristics, comparability, which includes consistency. We've talked about that. Verifiability. Two people working independently and applying the same rules should come to the same opinion and conclusion. They really get into these definitions in these little boxes on the in the margin. So pay attention to those. Timeliness. So it's available to users early enough to allow them to use it in the decision process. The key constraint, cost effectiveness. Now, remember, human error is another key constraint. And they get into the elements of the financial statements and the underlying assumptions, economic entity assumption, the going concern assumption, periodicity assumption, and the monetary unit assumption. They discuss each one of those at length. Here are the elements of the financial statements. There are the assumptions, and they talk about each one. I've talked about them already. A recognition and measurement and disclosure concepts. Recognition refers to the process of admitting information into the financial statements. So we get the revenue recognition principle, the expense recognition principle, for example. Measurement is the process of associating numerical amounts with the elements. And then disclosure, the importance of full disclosure and the place of disclosure as well. Now, the recognition criteria here, I'm not going to really spend, we've spent a great deal of time in chapter 6 talking about revenue recognition. We talked about expense recognition throughout the book. Measurement, we've talked about that. There are various methods of measuring things in accounting. We get historical cost, net realizable value, current cost, present value, fair value. Now they talk about each one of those at length. Historical cost, property, plant, and equipment is a common application of it. Net realizable value. They talk about here with net realizable value, estimating the selling price and more getting into inventory. But to me, the most obvious application of net realizable value is with accounts receivable. Remember, we recognize it at net realizable value, the amount we expect to collect. That's the reason we estimate bad debts and go ahead and recognize the expense and set up the allowance account. Current cost, you get into inventory with lower of cost or net realizable value. So that's tying in with net realizable value. It's also, remember, bringing in kind of the current cost concept of replacement cost as a consideration. Okay, present value basis, the asset retirement obligation, or ARO, is one where we got into present value. And then the fair value basis with marketable securities. So we have talked about all of those at some length. Here they get into the fair value hierarchy. I went over that some when we talked about marketable securities and the identifying of fair value there. We have 3 levels. The most desirable is the first level. The higher the level, the more desirable it is. That's quoted market prices. So, for example, on a stock exchange, quoted prices for that company's stock, that is highly verifiable. That's the highest level in the fair value hierarchy. Now, second is other types of quoted prices and observable values. For example, comparables on real estate would be an example of a level 2 fair value, and those are pretty reliable. Kelley Blue Book values for automobiles would be another example of a level 2. And then level 3, the least desirable, the unobservable inputs. And that's basically where a company just sits down and says, we think it's worth about this much. There's no comparables. There's assets of that type are not being sold. Let's say you have some land in an area where there have been no land sales for years. What's the land worth? Well, we don't know, but we think it's worth this much. That is the least desirable And if you're going to use that as a measure of fair value, you better disclose everything about it, including how you came up with those numbers. Okay, they talk about the fair value option. We went through that at length. And they get into disclosure, and the full disclosure concept principle is that we disclose everything that might be important to the decision maker or the user. And how do we disclose it? Well, sometimes it's parenthetical comments or modifying comments on the face of a statement. So, for example, with property, plant, and equipment, we may show property, plant, and equipment, and then parentheses net of X amount of accumulated depreciation. That would be a parenthetical comment on the face of the financial statements. Sometimes we have disclosure notes. In fact, we quite often have those. Usually the disclosure notes are a lot longer than the financial statements. And then sometimes you provide supplemental schedules and tables. So, and there we get into some discussion of those and the idea of evolving GAAP. And GAAP is still evolving. Now, I think I talked about this a couple of times during the semester, but there are two basic approaches to determining GAAP. One is the revenue and expense approach, which emphasizes the income statement, and the focus is on let's make sure we are measuring income correctly, and then whatever happens to assets and liabilities kind of is what happens. Now, the other approach is the asset liability approach, where we try to say, okay, let's make sure that we are properly measuring assets, liabilities, and owner's equity on the balance sheet. And once we have determined how things should be reported there, then net income is whatever it turns out to be. Now, historically, accounting standard setting making has taken a revenue expense approach, where the emphasis was on the income statement and making sure we were properly measuring things on the income statement. Now, increasingly, the FASB has moved to more of an asset liability approach, and we see that more now. That's where the idea of fair value really started getting more traction and being more widely applied, is to properly report assets and liabilities on the balance sheet. And the FASB has stated that they are viewing the asset liability approach as the more important approach, or the more valuable approach now. So we can expect to see that continue into the future. Okay, with that gets us to the end of the chapter. Now, the homework, I am not going to go through the homework in the same kind of detail. You notice we didn't go through any of it that I went through that I usually do. And the reason is because the statements are all asking you to do things that should be pretty second nature and should be really easy to you now, or they're coming in and asking you to look at those principles and figure out which one applies, which assumption or principle applies, and was it applied correctly, or identify the elements of the financial statements. And so I don't want you to just take a picture of those and go in and plug them in. I want you to read these and think about them and think about what applies. So I'm not going to go over the homework for chapter 1. So this actually gets us to the end of the material. I will put out a video to let you know what to expect for the final. But this will conclude the videos for chapter 1. Be sure and do the homework. And call me or email me if you have questions for me. And good luck to you. Work hard. Finish strong. Goodbye.